So this latest Fed meeting was a big one. The Fed finally cut, and they cut more than we were expecting. They cut 50 bips. And today we're going to just take a look at what that means and, what are the implications for the market. So Victor, you're going to give us a little background here, kick us off.
Yeah, for sure. And when we say bips, that's just kind of slang for basis points, which is a basis point's 1/100%. So 50 bips in this case, that's 0.5%. And so originally we were in the target range of 5.25% to 5.5%. That 50 basis point or 0.5% cut was pretty substantial because the market was really trying to weigh, hey, are they going to do 25 bips? Are they going to do 50 bips? I mean, frankly, it was fairly exhausting listening to the market commentary with strategists on both sides, economists on both sides of that. And so it was really nice to see that we finally got that first Fed cut that we've had in a long while. So the Fed hasn't actually cut rates since back in 2020 when they essentially cut rates to zero because of the COVID pandemic and everything that was going on with that. And then they haven't even made a rate change in over a year once they had finished hiking rates in July of last year. So this one was pretty substantial. A big part of this report was also the Fed every other meeting on a quarterly basis. They release what's called the Summary of Economic Projections, or SEP. That's accompanied by the dot plot. And the dot plot is essentially, as you know, all the Fed governors get to and presidents get to put a dot on the dot plot of where they expect rates to be by the end of this year, by the end of next year, so on and so forth, and their longer term expectations. And so that gives us a lot of insight into what the individual presidents and governors are thinking. And what we saw was that governors and presidents are essentially expecting another 0.5% cut between now and the end of the year, and then 1 percentage point of cuts in 2025. And I think, we can kind of talk through this a little bit. I'd expect slightly more than that in 2025, just based off of the inflation trajectory, but we'll get into that over the course of the episode.
Yeah. And one of the big things I want to take a look at and just, dive into from the meeting was not just what they did, but what they said. And so the press conference is always just as big of an event as the actual decision is, because we were saying, between 25 or 50 basis points, it didn't really matter because the commentary would probably make up for the difference. But in this case, we got 50 basis points and a very dovish Jerome Powell in the press conference. He was very upbeat about not only the broader economy, but also the job market, which is something that people have been increasingly pointing to as an area of concern, because now that inflation's coming down a lot, and we'll talk more details on that in a minute, but inflation's come back in essentially to what they're looking for. It's coming back down. We're not quite there yet, but by a lot of measures we are. And so people have kind of shifted to the other side of the Fed's dual mandate on the job market, showing concern there. Unemployment's rising a little bit. Granted, we're still in a very comfortable, almost full employment kind of place, so it's not a big issue yet, but people have been worrying about it. Jerome Powell really came in hard on that topic, saying that doesn't see any issues there. He's still confident. So lots of optimism coming out of the Fed out of this meeting.
Yeah, definitely. And I know that you mentioned the word dovish in that, piece that you just said. Do you want to kind of remind our listeners of, we've talked about it before on podcasts, of course, but the difference between dovish versus hawkish when it comes to Fed commentary? Yeah,
good catch, Victor. Thanks. So dovish essentially just meaning very much more easy monetary policy in the camp of cutting. Cutting is a dovish activity versus hawkish being the opposite of that, suggesting potential issues, suggesting, inflation's not there yet when you keep rates higher for longer, which is what we're seeing for a lot of the last year or two.
Exactly. And I think that kind of brings us to the question of why 50 bips. Like I said earlier, market was really debating between 25 or 50. Going into the meeting, the futures market had it pretty much priced 60% chance of a 50 bip cut, 40% chance of a 25 bip. So it was really looking at close to a coin toss there. And I think a lot of it was because the last time you and I talked about the Fed on the podcast was they kind of missed an opportunity to cut back in July. And things are looking pretty healthy, as you mentioned, between inflation and the job market. So I think they felt comfortable going 50 basis points. They don't want to stay restrictive and too restrictive for too long because that can have negative economic implications. And that kind of brings us to, so first, kind of a catch up from July when they didn't cut. And then that brings us into the Fed's dual mandate. You touched on this already, but they're really trying to balance that combination of proper inflation being that 2% target that they have, and then having a healthy job market. So keeping unemployment right around that low kind of 4% range. And what we've seen recently is inflation has substantially moved in the right direction. I know you're going to talk about that in a second. But then when you go to the job market side of things, it's gotten a little bit tighter, a little bit more frothy in the job market. So jobs are not quite as prevalent as they were. The unemployment rate has ticked up somewhat significantly, but it seems to be leveling out in a pretty healthy area. So as far as the job market side, I feel like the Fed, wants to balance that risk. And by cutting rates, they're making sure that the job market isn't going to devolve into something that looks like a recession. Because when we talk about recessionary periods, that's of course, business slowdown and contraction in GDP, but a lot of that's driven by the fact that the job market isn't good, then people aren't making as much money and they aren't spending as much, and GDP is 2/3 of that is consumer consumption. So that's important for us to remember.
Yeah, and then on the opposite end of their dual mandate, as we've talked about, is inflation. The big battle that we've been fighting for a long time here is really coming back in. If we look at 3-month annualized inflation, 3-month annualized core inflation is, what the Fed's looking at. That's total headline inflation, excluding food and energy, just because those are so volatile. But that 3-month annualized core inflation is at 2.4%. Their target's 2%. So we're right there. And then if we exclude shelter from that, we're actually at 1.6%. So past that for a lot of Americans. So because if you own your own home or your shelter costs are relatively fixed, you have your fixed mortgage, fixed payments, and whatever context that may be, is for a lot of Americans, they're back at that 1.6% 3-month annualized inflation. Granted, the price levels are a lot higher than they were a few years ago. So you're still seeing what we perceive as high prices in the grocery stores and, the wherever you're shopping, but those prices aren't getting a lot higher very quickly is the big difference there.
Right. And that's nice to know from a consumer standpoint. And as you and I look at things from an economic perspective is, hey, you don't want people having to spend more and more on top of what is a really high base coming out of COVID, because that change, as we've talked about before, has become really significant. So the fact that that's cooled significantly can give the Fed some confidence that, hey, we can let monetary policy ease up a little bit, let money flow throughout the market a little bit better. And I think that kind of brings us to, hey, why does this matter? Why do interest rate cuts matter? Why does monetary policy matter so much? And I think a big portion of that is just, number one, easier monetary conditions throughout the market. A lot of that having to do with borrowing and lending. And of course, as rates come down, typically across the board, interest rates will pull back a little bit, makes it easier for corporations to borrow because they're borrowing at lower rates, and makes it more palatable for banks to lend, because throughout this whole, last 12, 18 months where short end rates have been high, they're having to pay out savings, CDs at pretty substantial rates, close to 5%. And so they're going to have to lend money out at 5+. You're talking, if you want any kind of spread, 6, 7, 8% in order to make a spread on those dollars. Or they're just not going to lend it all. They're going to lend that money back to the Fed and get paid the Fed funds rate right at that 5.25%, 5.5%. So a lot of the banks have just been putting excess cash, sending it to the Fed, getting those overnight payments. But now you're kind of creating a dynamic where, hey, rates are coming down. They can reduce that amount that they're paying in those CDs and short-term instruments and do more lending in the market, because a lot of corporations, really during COVID, when rates were so low, they pushed out their debt maturities until 2025, 2026. but all of that debt is starting to come due. And so what they're going to have to do is re-up on those bonds, renew their loans and their borrowing so that they can push it out again. And so now that those rates are coming down, it's looking a lot better for corporations from a borrowing perspective.
Yeah. And then looking at the consumer perspective on that one, as far as the money markets go, we have how many trillions of dollars sitting on the sidelines, sitting in money markets because they're yielding, 5% right now. Well, that 5% just turned into 4.5%, or not quite that, depending on, where you're at. And so that's a big difference for people. Just overnight, change, because those change immediately with the Fed funds rate. So, and especially throughout the rest of the year, if we get another, like the SEP you mentioned, forecast another 50 bips this year of cuts. So, by the end of the year, we're down a full percent from, that 5.5% that you're getting on money markets right now. So that's going to push a lot of those dollars into the, equity markets, into, higher yielding products such as bonds. But the thing with bonds is that they're also coming down. Those yields follow the Fed funds. So the Fed funds can affect the short-term rates, but that also has implications for the rest of that yield curve that is going to be coming in. And so your bond, yields are going to be lower. That's going to push bond prices up for those existing bonds. Existing bondholders are going to be happy about this, but it's for someone getting invested, getting those dollars to work. It's that's going to be a lot of money going somewhere. So that's going to be a lot into equities. And then part of that too is real estate prices are going to start going up because those are valued, based on cap rates, and very, very interest rate sensitive sector that, this is going to really push up.
Yeah, no, you're exactly right. And I think cash has been a super popular trade over really the last 12 months, 18 months, because there's all these questions about the economy. Are we going to reach a soft landing? And it's really looking like, and then at the meantime, while you're trying to figure out what the economy is going to do, you're making 5%. And so that seems almost like a no-brainer. I mean, it's hard to argue that you should take on a bunch of risk whenever you're looking at 5% on cash, which isn't super substantial, of course, but that's very, very safe money, essentially guaranteed. So, as far as the risk reward profile, now that's coming into more balance because you're looking at other opportunities outside of cash, equities, maybe some different types of bonds and other fixed income that can juice up that yield, because you're not going to be getting 5% at the short end of that curve. And think about, especially by the end of next year, you're talking about 2 full percentage points of drop from where we initially were. You're talking about that money market going from somewhere around 5% to somewhere around 3%. That's hardly keeping up with inflation at that point. So you're not really feeling too amped about that investment. So what you're going to see is those dollars kind of flow into other areas of the market. And you mentioned a few of those. I think another one is, dividend yielding securities, anything that's some kind of yield based product or investment is going to do fairly well. You mentioned bonds, but I think dividend equities are, a good part of the market to kind of be exposed to right now, because you're getting that yield, which is looking more and more attractive against traditional fixed income. And you can have earnings growth if you're looking at the right companies on top of that.
Yeah. Over the past decade, a 5.5% dividend yield has looked generous. That's been a high dividend stock. Now you can get that in the money market. Why do you need to take, equity risk to get that? Well, you don't. You just go put in the money market. That's really depressed a lot of the valuations on these companies. So exactly to your point, it's going to really help those dividend paying stocks. And so, that kind of leads us into, finally, I think, the job market's still strong. And as long as that remains so, I think we're really in a good position for Jerome Powell's soft landing.
Yeah, I think everything looks pretty solid. And you and I have kind of felt this way for a while. The market's really been grappling with it, but we've been watching inflation essentially since it peaked, even before it started peaking back in 2022. And we saw that once it started coming down, that you had this persistent, disinflation in the market. And we really feel more confident about that now because it's really shelter prices which are holding up that inflation figure. Everything else is in a very modest range. So you can basically put a check mark next to the inflation, part of the debate.
I mentioned a few inflation figures earlier, but to that point, total inflation, including food and energy, excluding shelter, is at 1.1% 3-month annualized. So you're way past the Fed's target, almost concerningly so. But obviously shelter is still an important piece in this. So we haven't really shot past the Fed's inflation target yet, but that's something to consider is shelter holding up inflation now.
Exactly. And that's part of that decision to go 50 bips is the Fed doesn't want to go past their inflation target, especially substantially, maybe for a short period of time in the high 1% range. But as we talked about on a couple episodes ago, a certain amount of inflation in the market is fundamentally healthy because you want to incentivize reinvestment. You don't want money to just sit in bank accounts, sit in, coffee cans underneath the bed. You want that operating in the market because it creates a better dynamic for everybody who's involved. But that's an excellent point there. And then as we were talking about before, the job market seems to be healthy. Things are in pretty good balance. So I think when you're talking about the broad market implications of, as investors, what does this really mean? What does the Fed trajectory mean? I think you're going to have a light tailwind to markets over the next couple of years as these Fed cuts continue to be implemented. Of course, the Fed has talked a lot about being data dependent, and they're going to continue with that, with that perspective. So we are going to have to watch inflation figures. We're going to have to watch job figures. I think the risks to the broader economy are that the job market deteriorates faster than the Fed can cut rates. But we're just going to have to see how everything plays out.
Yeah, well, we'll be here to keep you updated every step of the way too.
Absolutely. Thanks, Hunter.
Thanks.